welcome to the Roundup covering what's important to accountants and advisors across the month of August. Inside this month, what's sparking the ATO's interest on non-resident withholding tax arrangements. We'll also give a quick update on the tax practitioner reforms. But first up, the ATO have released new guidelines on the possible application of Part 4A to clients earning personal services income. Michael, why the guidelines? Why now?
Yeah, so when you have clients who are earning personal services income, particularly those earning PSI through a company or a trust structure, there are a couple of key tax issues that we need to consider. The first thing we need to do with clients in that scenario is work our way through the PSI tests, and they're either going to be passed or failed. If the PSI tests are failed, then there are some things that happen automatically under the tax system. That includes the automatic attribution of the net PSI profit or loss to the individual who performed the work. So regardless of whether that amount is physically paid to them or not, the tax rules will automatically attribute the net profit amount relating to their personal services so that it is taxed in their personal hands at their marginal tax rates. So that's a direct consequence of failing the PSI tests. Other implications are that you potentially lose out on some deductions, so certain things are not deductible when you fail the PSI tests, and there are some specific PAYG withholding rules that apply to clients in that scenario. Now, when clients are able to pass the PSI tests, we would refer to that as a personal services business, PSB. And when you're in that category, you do not have the automatic attribution of the net profit relating to personal services occurring under the tax system. So you don't have automatic attribution of income, but that doesn't mean that you couldn't potentially be triggering integrity rules or anti-avoidance rules in the tax system. And in this space, the most relevant integrity rule is Part 4A, the general anti-avoidance provisions. What the ATO has told us for many years now is that if you are earning personal services income through a company or a trust, there is a risk that Part 4A could apply if you retain profits within a corporate structure so that a lower rate of tax is applying to some of those profits, or some of those profits are split with others, and typically it would be with related parties. Again, with the view that some of those profits end up being taxed at a lower rate than what they would otherwise. So we have had guidance for many years now where the ATO has said that those two things potentially lead to the risk of Part 4A applying. What this draft PCG does is it builds on that existing guidance and it sets out some specific factors that need to be considered in determining whether Part 4A maybe could apply or not. And the ATO sets out a number of low risk and higher risk scenarios. So a series of examples, some which basically lead to the conclusion that the ATO wouldn't bother wasting compliance resources because these are low risk scenarios. But then there are the other ones, the higher risk scenarios, where the ATO says it doesn't necessarily mean that Part 4A will apply, but you are opening up the door to the ATO potentially taking a look at that scenario from a Part 4A point of view. So these guidelines, as I said, they build on existing guidance. This concept of Part 4A potentially applying to PSI profits is not new. The concept has been around for a long time now. This is something that's actually been tested through the courts over the years. But this is new guidance in terms of building on and expanding some of the ATO's existing comments and putting it in a more practical way with a series of examples.
Are there scenarios covered in the guidelines that we haven't seen before?
Yeah, so while the concept of the possible application of Part 4A to PSB type situations is not new, this has been around for a while. And while we have had guidance from the ATO in a fairly broad sense in terms of the types of things that might trigger a Part 4A kind of issue. There are certainly some examples in the guidelines that I'm certainly not aware of previous specific guidance on, and I just want to cover two of those with you. The first one is a low-risk scenario. One of the low-risk scenarios that the ATO covers in the draft guidelines relates to situations where, particularly where you're running a business through a company structure, and there is a desire to retain some of the profits that have been generated so that those profits can be used to acquire new assets for the business. Now, I guess from a practical point of view, it has always kind of felt like this should be okay, but we now have a specific example from the ATO which says, look, yeah, if this is structured well, this should be considered low risk. Basically what the ATO is getting at is that if there is a genuine commercial need for the business entity to go and invest in a new asset, and that is imminent, it's going to happen at some point fairly shortly, then it would be acceptable to retain some of the PSI-related profits within the company so it can then go and spend the money buying new assets for the benefit of the business. So it's nice just to have something in writing from the ATO confirming that that would be okay. Now, contrast that though with a situation where the asset is going to cost $10,000, but you leave $50,000 in the company. That would not look so good to the ATO, and that would be inviting a Part 4A sort of issue. The other scenario, which is just worth covering, is on the higher risk side. The ATO deals with a scenario that we've been asked about many times over the years and never really been able to find anything concrete on. And that's dealing with a situation where you're running that PSI business through a company or a trust, and it is generating losses or has already generated losses from other activities, separate activities. And the issue is then, well, if the company or the trust is able to pass the general loss recoupment tests, well, presumably, those existing losses would be offset against the current year PSI-related profits and would reduce the taxable income or net income of the trust. The issue, though, is, well, how would the ATO see this from a Part 4A point of view? Well, the draft guidelines indicate that the ATO does see this as a Part 4A issue if the profits that are sheltered by those losses from a tax point of view are left in the entity and are not paid out to the individual who's performing the work, so that it would be taxable in their hands, probably as salary and wages. So again, nice to have the ATO's views on it. It's not going to be a popular view, but at least we've got something from the ATO that addresses that scenario. As I said, it's something that comes up reasonably often, so that is something to be on the lookout for. If you have clients who are running PSI activities through an entity that is generating losses from other activities, or has carried forward losses from other activities, beware. That is the sort of thing that you need to be very careful about. The ATO is saying that basically leaving those tax-sheltered profits in the entity, you could be exposing client to Part 4A. So a couple of things, some good, some not so good, depending on your viewpoint, that we need to be conscious of. But again, it's a draft guideline at the moment, remember that. When final guidance is released, we'll obviously be taking a closer look just to see whether there's any significant modifications. There are a few gaps in the guidelines. For example, they don't talk about partnership situations at all. So we've already raised that with the ATO. We're hopeful that they'll address that. We'll wait and see, but we'll certainly give you more updates as they come to hand later on.
Knowledge Shop will be hosting a webinar on the potential application of Part 4A to clients that earn personal services income on the 24th of September. I hope you can join us for that one. Now, across to the ATO, who is stepping up their focus on withholding tax obligations on payments to non-residents. And how do clients know when they're subject to withholding?
Yeah, so generally clients could consider whether withholding tax could apply when they are making payments to non-residents for interest, unfranked dividends, or royalties. This includes where trusts are making distributions to non-resident beneficiaries. However, if the payment is to a non-resident that is carrying on a business in Australia or operating through a permanent establishment here, no withholding tax should be applicable. 10% withholding tax is imposed on interest payments to offshore non-resident lenders. This includes accrued or capitalised interest, even where the interest has not yet been paid. 30% withholding tax can also apply to royalty payments made to non-residents. For example, in the recent PepsiCo case, the ATO claimed that a large undissected payment for goods and services to an overseas entity included a portion of royalty to which royalty withholding tax was imposed. In July, the full federal court held in favour of the taxpayer that there was no royalty component and therefore no withholding. However, the ATO has now appealed this decision. Also, 30% withholding tax applies to unfranked dividends paid to a non-resident. Fully franked dividends are exempt, as well as dividends paid to certain foreign charities, public educational and cultural institutions. This applies irrespective of whether the dividends are received directly by the shareholder or indirectly through a nominee or trustee. As for the rate of withholding tax that should apply, while the legislation has standard rates, these can often be reduced under the terms of the relevant double tax agreements, which should always be considered.
From a practical perspective, what should clients be doing about this to manage their obligations?
Yep, so if withholding tax applies, the entity needs to register with the ATO for PAYG withholding and will need to lodge a PAYG annual report, usually by the 31st of October each year. Any payments need to be included as part of their BAS statements. The timing of reporting and paying withheld amounts will depend on whether the taxpayer is a small, medium, or large withholder, which depends on how much they are withholding each year. It is an offence to fail to withhold, and significant penalties may be applied against the resident payers who fail to withhold and remit the required amounts to the ATO. Generally, the penalty is equal to the amount that they should have withheld plus interest. Also, no deductions are allowed in respect of the payment until withholding tax has been paid and remitted to the ATO. For trustees, where there are amounts withheld, they also need to attach additional statements for each non-resident beneficiary to the trust tax return, which discloses additional details for the amounts paid or distributed.
Now, finally, a quick update on where we stand on those code of conduct changes for tax practitioners. It's all moving very, very quickly. Now, as you remember, the Minister created 8 new code of conduct obligations via a legislative instrument, via a determination. Now, these additions were to take effect from 1st of August, but then transitional rules were announced not long afterwards under pressure from the professional bodies. Now, these new transitional rules allow for smaller practices with up to 100 employees a start date of 1st of July 2025. And for the larger practices of 101 employees and above, until 1 January 2025. Since then, a Liberal senator has moved to disallow the determination, and we'll know the outcome of that on the 10th of September. So look out, we'll keep you up to date as soon as we hear. But also, in the interim, the Assistant Treasurer has amended the determination with the transitional rules, circulated those to the professional bodies, but also announced that 2 of the more controversial measures will be subject to consultation. Now, these 2 measures are the false and misleading statements. So this is the thing where tax practitioners are obliged to correct misstatements either by themselves or when they know somebody else has made a misstatement. And the other one is the requirement to keep clients informed of relevant matters. Now, these relevant matters are relevant to your tax practitioner licence itself. So if you're sanctioned, if you're under investigation by the TPB, that's the measure that requires you to alert your clients that you are under investigation. So those 2 will be under consultation. But this is very much a moving feast at the moment, and we will bring you more as soon as we hear some of the outcomes of these changes coming through. And that's the tax roundup for this month. If your firm is not a member of Knowledge Shop, we'd love to show you what a difference we make to thousands of practitioners every single day. Give the team a call or jump onto the website and book in a time for a tour. We'll look forward to speaking to you soon.